Why did inflation always come back in the 70s and 80s? This is a great question because inflation at the moment does not seem to be embedded in expectations. It's certainly not embedded in bond prices and forward inflation expectations. So how did the Fed have such a tough time in the 70s and 80s? They raised rates and then they triggered a recession and inflation came down, but it seemed that inflation always came back stronger. Why is that? The answer is because once inflation expectations became entrenched, people had continued for too long and people lost their trust that inflation could be controlled. So even when the Fed raised rates and triggered a recession and inflation did come down, people still built a buffer into their, for example, wage negotiation renewals, their contract renewals. They always built in a buffer for inflation because they had a thought from recent experience that it would come right back up. Now, if you consider what's happened in recent memory, we saw dramatic inflation in just recently in the past couple of years, 2021, 2022, and say we have a recession and the Fed cuts rates, becomes dovish, cuts rates deeply, market participants who have seen what have just recently happened will have it fresh in their mind, and what do you think they will do? Of course, inflation expectations will come back. It'll most likely be self-fulfilling. They'll probably buy gold and other inflation hedge assets. And similarly in the economy itself, people who have recently just seen it happen will probably, even during the downturn, start embedding some protection into their contract renewals and such. The danger is if you have this go on long enough, what you saw in the 70s and 80s is that inflation expectations were entrenched. And so today, for example, you don't see bond prices really reflecting this, especially, for example, forward 5-year tips, expectations on real yields and such. It's because bond investors have not been brutalized yet by years of sort of volatile inflation and monetary policy. A further wrinkle, as we've discussed in other videos, is unlike the 70s and 80s, this time around the debt to GDP ratio is much higher, 120%, for example, versus 30 or 40%. Back in the 70s and 80s, with that low debt to GDP ratio, you had ultimately a Fed chair like Volcker who could afford to raise rates to, say, 20%, even for a brief period of time, because debt levels were affordable. Today, if you were to raise rates higher for a sustained period of time, the interest on the public debt would be completely unaffordable, and we would be essentially adding more and more to the deficit on itself. So this is something to keep an eye out for, because remember that in the 1962 to 82 bear market, you had a couple of decades where the S&P 500 stayed flat, but it declined 75% in real terms. So definitely watch out. Inflation is something that can hurt both real estate investors and stock investors. So never be complacent. And if you're looking to buy or sell property in New York or Florida, check us out at Hauseit.com. We can help you save 6% when you sell with an agent-assisted FSBO listing. And if you're looking to buy, we can help you save 2% or more with a Hauseit buyer closing credit, where we give you 2/3 of the buyer agent commission, subject to us keeping a minimum. My name is Chris at Hauseit. We hope to see you on the next one.